You can take the S&P and with dividends reinvested, which nobody ever does over that same time frame, gold beats it just barely, 9.9 to 9.6. Look at it last year, up 60%, up this year, 60%. At what point do people start to legitimize it? I don't know. But ironically, if you take any asset you can think about, just about, and value it in ounces of gold, going all the way back since 1971, prices are falling in gold ounces. They're going way up in dollars. It just is continually outpacing people's expectations, but yet they don't even notice it. They don't acknowledge it. And here we are with it being one of the best performing assets of the last decade. And it's completely and totally underowned by the public for whatever reason, I don't know.
Key thing I'm worried about is the stock market just follows the lead of Bitcoin. It was up a lot and end up down in the year. That would be a crash, but we're heading that way now. And it's the time of year people are just de-risking what stops it. I don't know anything stops us now.
As of November 2025, central banks have already purchased over 950 tons of gold in the first 10 months, on pace to shatter last year's record of 1,082 tons, with fresh reports showing Turkey adding another 25 tons in October alone, and Hungary quietly raising its reserves to 100 tons for the first time since the Soviet era. Silver backwardation on COMEX hit its most extreme level since 2021, with the front-month contract trading $1.80 above later months as industrial users and refiners scramble for immediate metal. In a new interview, Miles Franklin PreciousMetals, President Andy Schectman explains why the public remains the last major participant to wake up to this move. He highlights that sophisticated money, central banks, sovereign wealth funds, and even major Wall Street CIOs, now openly calling for 20 to 25% portfolio allocations to gold, have been aggressively accumulating for years, while retail investors stay fully invested in record margin debt and options exposure. Schectman argues we're witnessing a historic rotation driven by eroding global trust in the dollar system, not speculation, and warns that this time really is different because the 40-year bond bull market is over and counterparty-free physical metal has become the ultimate expression of trust. Let's watch clips from Andy Schectman's explosive interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
It's interesting because the public is really hasn't been a massive participant in the gold rally. It's been more along the lines of the central banks and whoever the heck is importing billions upon billions every month into COMEX, the sophisticated traders. Maybe it's some of the people listening to the chief investment officer of Morgan Stanley who said, sell half your bonds and put 20% into gold, or Michael Hartnett from Bank of America who said, no, make it 25%. Or Jeffrey Gundlach, who said, no, 25% is not overweight. Things I never, ever thought we would hear. I think the public is behind the curve. And if you look at the recent data, they're all in the stock market, highest ever, largest margin debt ever, largest option exposure ever. The public's in the market. The big money, the central banks, the commercial banks, the sovereign wealth funds, they're the ones that have been driving not only the gold accumulation, but the deliveries off of the exchanges. So I think the public is the last one to get involved, and really, other than some very large orders by people who are paying attention, I would say the public at large is not involved in this market hardly at all. I mean, one of my very best friends manages $3 billion for Morgan Stanley here in Boca, one of the biggest in the state, and he wouldn't know a gold coin if it fell on his foot. Yet their chief investment officer is saying put 20% in gold. So I don't know. I think typically, and maybe this is why there's the whole theory of Elliott wave and Kondratiev wave theory, human emotions that drive the market. I think maybe they have to see it with their own eyes. But, people who are successful, I think, move before the trend. And that seems to me to be the central banks who've been doing this for the last 8 years, and now the sovereign wealth funds, and now the commercial banks. So I don't know. Maybe it just is validation they need to see with their own eyes instead of doing what the biggest money has been quietly doing for quite some time. And you look at how gold has performed, it's really done amazingly well and it's outperformed most assets. The fact that it hasn't been embraced, I don't know, it's a mystery to me, quite frankly, but I would think that it has to be validated by people's own eyes before you see anything substantive with the public or the local money managers or financial advisories. I got another money manager, ironically from Morgan Stanley, lives across the street from me. And the only time he ever says anything to me is when gold and silver fall. You yell across the street from me, "What's going on with metals?" I want to just say, "Shut up, man." Like, he never talks to me about the fundamentals. It's buy bonds and retire, blissfully. I just think that it's been whitewashed so much to such an extent that the public doesn't quite get it yet. But you look at a market that, has doubled the performance of the 10-year Treasury over the last 25 years. You can take the S&P and with dividends reinvested, which nobody ever does over that same time frame, gold beats it just barely, 9.9 to 9.6. Look at it last year, up 60%, up this year, 60%. At what point do people start to legitimize it? I don't know. But ironically, if you take any asset you can think about, just about, and value it in ounces of gold, going all the way back since 1971, prices are falling in gold ounces. They're going way up in dollars. It just is continually outpacing people's expectations, but yet they don't even notice it. They don't acknowledge it. And here we are with it being one of the best performing assets of the last decade, and it's completely and totally underowned by the public for whatever reason. I don't know. Going back and looking what happened in 1980, at its previous peak, Volcker raised interest rates to 18.75%. That's not going to happen now. I don't know how many global rate cuts we've seen this year, 500 or more globally. The pattern is for lower rates, of course. At least that's what they want. And I think it's very different when you see countries like Poland, who started out with their target at 20% for national reserves, raised it to 25%, and now they're going to 30% national reserves. You look at the amount of gold that is being imported by the central banks. There was just an article that came out that said only 1 in 3 transactions is actually being reported. They're buying way more than they are telling. All of the central banks. You look at the United States, we've become a net importer for the first time ever, and we're importing billions and billions and billions every single month. I think it is different this time because a system, the United States, which has flourished, you go back to 82, interest rates fell at a 45-degree angle ever since, making traditional assets what everybody wanted, and this country was revered and trusted. And you look whether the repo market right now, where the banks aren't trusting each other because there's double the liquidity in there than we had it in 2019, and yet the Fed just came in with 125 billion over 5 days. That's crisis level. You look at the backwardation in the silver market. They don't trust that they'll be able to roll their contract forward and get it in the following months, or they don't want to cash settle. They want the metal now. You look at de-dollarization. You look at all of this stuff. It's all based upon a lack of trust, whether it be globally with the de-dollarization and the Treasury issue with sanctions and tariffs masquerading as sanctions. You look at all of this stuff, and I see an issue of trust and fiscal irresponsibility, where in 6 weeks that the government was closed, we added $500 billion in debt. The previous trillion happened in 71 days. A trillion seconds ago was 31,688 years ago. We're fiscally irresponsible. Nobody trusts us. The markets don't trust anyone. The banks don't trust anyone. This is a game that I think is about the United States has lost trust, and the markets have lost trust. And even the participants in the overnight repo market trading 24 hours next day, not even just overnight. No, I don't trust you. So why did the Fed have to come in and put 125 billion in? I think it's different in the respect that you could argue if it were a chart that the U.S. peaked on its way up to 2011 or 2020, and it started to come down. And that's kind of where we are now globally with the lack of trust. So to me, gold is trust. It's trust because it is not someone else's liability. It's an asset that has no counterparty liability if it's in your own possession. So I get it. I get why you would say that, because history hasn't been kind to gold. But I would argue maybe history won't be kind to the U.S. dollar the way that it once was, or the desire to hold our treasuries the way that it once was. So I guess that would just be my own pushback.
Bloomberg senior commodity strategist Mike McGlone warns that the Bitcoin-gold ratio collapsing from 33 to 21 ounces signals classic de-risking and the likely end of the equity bull market. With the VIX 200-day breaking out of a 6-month bull flag, Bitcoin's 200-day turning lower, and gold massively outperforming while volatility remains buried, McGlone sees stocks poised to follow Bitcoin's lead into a sharp 2025 decline, repeating the 2007 to 2008 gold spike then correction pattern before the real crisis hits. Let's get back to the interview.
Well, markets peak on euphoria. We're seeing classic de-risking. We just look at Bitcoin, it was up 33% on the year. Right now, it's down 8%. And a year that gold's up 55%, I'm sure Andy's going to knock on that one a little bit, is are we going to look back from the future and say, yeah, gold's up 50% and beat everything, it didn't really matter? And I think it's now starting to matter. We're finding out what happens when bull markets end is markets stop going up, even though earnings and all the news becomes better and better. It's usually the way bull markets peak. And I think we're doing that now. The key thing I'm worried about now is what we're seeing happening this year is Bitcoin breaking down, gold rallying is signaling things that are going to matter and look back from the future. And I can show you a few charts and we can flip it over. I can wait till later on that. But it's the key thing I'll point out is we have had the VIX 200-day moving average in a bull flag since April. It's breaking out higher. We still have 120-day volatility in S&P 500 at 11%. That's the lowest. On a year-end basis, it'll be the lowest since 2017 if it doesn't go up. There's just nothing good here. And then I'm really worried. The key thing I'm worried about is the stock market just follows the lead of Bitcoin. It was up a lot and end up down in the year. That would be a crash, but we're heading that way now. And it's the time of year people are just de-risking what stops it. I don't know anything stops us now. Let's put ourselves looking back at 2025. Bitcoin had this major real high in reversal. Is the stock market, we're going to look back and say, yeah, it was just a leading indicator for stock market. I think that's probably what's going to happen. First of all, I'll start with my favorite ratio in the entire business is the ounces of gold for one Bitcoin. It's broken down through key support at 25. It's at 21 now. Our model says it should go to 13. You know, I pointed this out for a while, but the bottom line, why I stick with it going lower, is stock market volatility. 120-day volatility is still absolutely buried at the lowest since 2021. If we end the year here, meaning if we don't have more volatility, it'll be the lowest year end since 2017. That's unlikely. To me, it's just getting started. And I want to show you the same thing as we've never had a year with gold up this much and Bitcoin down this much. This is a Bitcoin down ratio without the S&P 500 down on the year. Now, we've only had 2 down years since Bitcoin was launched, and since 2008. And this is still a red year. What if it goes red on the year? It would make sense. It's hopefully, and if it doesn't go this year red, we're probably going to get the 3rd down year in the S&P 500 since 2008. It's just a matter of time. That ratio is telling us. I also point out, here's one key thing that really concerns me, is this is the S&P 500 announces a goal. You know, you can go back 100 years. It's breaking down through key support. It's broke through that low in 2020. This is a month end. We have to go back to the base was set up 10 years ago, 15 and 16. We're potentially going to break through that level. At the same time, I overlay this with Bitcoin versus gold. It's also breaking through key supports. And then I like to point out, here's the key leading, the tip of the iceberg strategy. We all know what strategy's 200-day moving average rolled over. Bitcoin's 200-day moving average has rolled over. It's hard to see it here, but it has. What's next? S&P 500. It's logical, but here's another key reason. This is the VIX 200-day moving average. It's been in a bull flag pattern since May. It's just breaking out higher. It's just getting started. So I also like to point out another key thing is, again, here we have stock market volatility buried. This is 120-day volatility, but this is another way to look at gold divided by S&P 500. 200-day moving average is just starting to turn upward. And again, what's the same thing? We have the VIX actual volatility absolutely buried versus the VIX. It's just a matter of time it catches up and VIX goes higher. It's just a question of when. So I have 2 more I want to show you. And this is one thing I'm concerned about gold. Here's just a gold chart going back to 1971 when we came off the gold standard. And I like to take it simplistically, just to take gold versus its 60-month moving average. It's exceeded the high from 2008 a little while ago, and that was only a 1/3 correction. And then exceeded the high from 2011, which was the peak that lasted for 10 years. You have to go back to the 70s. This is when it went from 300 to 800. I remember this. And then it went back to 300, and it stayed around that level for 20 years. It's not a place I want to be outright long gold. That's why I'm concerned about selling everything. And I'll end with one key chart that might be the next big trade. This is the total return of the TLT ETF divided by the total return of the S&P 500. See that hockey stick going straight down? I'm afraid it's going to do the hockey stick part now. It was hovering. This is just from a base of 100, 2001. It hovered around 100. The peak around 2020 was 100. Now it's at 22. It's so buried. All it takes is a little flip for that to pop up. The S&P 500 giving back some more gains this year, and I think we're going to see that hockey stick kick in. And yes, I've been wrong on this one for 2 years. I've been very bullish gold forever, but at a certain point, I have to switch off my hat to from fundamental or technical analyst. I'm both. I'm whatever I think works, to a risk manager. And I look at it, if I'm running any money now and everybody in my desk is overweight gold, partly because the market made them overweight gold, this is a level I have to be very cautious. Now, I'm very worried what it's going to do, something similar to in 2008. Initially, remember 2007, it was up 30%. Fundamentals are great. It popped up 1,000 in 2008 in Q1, and it dropped to 700, dropped 30% as we entered the crisis of 2008. I think that's happening now, and that's part of what gold just front runs things. But that's why I just put on my, I've shown that chart. I just put on my risk manager hat and says, basically, when you get this stretched in gold, and the fundamentals everybody gets, it's just we haven't had the pile on yet from stock market going down, is to have the discipline of knowing where and when to buy. Now, you've been long and bullish gold for quite a while. I have, and basically been way overweighted. And I look at, sometimes it's okay to say, take some profits and do a little selling when the market's yelling.
The world has changed. Central banks, sovereign funds, and now Wall Street CIOs are quietly rotating into physical gold at a record pace while trust in the dollar system collapses. The public remains the last buyer, fully leveraged in stocks and oblivious. This time really is different. The 40-year bond bull is dead and gold is trust. Gold's outperformance against a crumbling Bitcoin and buried volatility screams classic de-risking. History shows extreme gold strength in the early crisis phase, 2007 to 2008, precedes a sharp correction when equities finally crack. The VIX breakout and Bitcoin's broken 200-day warn the real storm is coming. Take profits and prepare. If you found their breakdown helpful and want to stay ahead of these historic market moves, make sure to like, subscribe, and turn on notifications so you never miss an update. Your support helps the channel grow and keeps you informed when the markets shift next.